Good day, everybody. I'm Dale Pinkert. Welcome to FACE if you're new. So today's Wednesday, but since it's the second full trading day of the week, I'm going to view it as a potential turnaround Tuesday. So I've been scanning the market, looking for scalps, and I really have to drill down to some shorter term time frames. So, this has nothing to do with any of the pattern and plays or anything, and we might be a candle early, but we are beginning to diverge on the 30-minute time frames in both the dollar index and the euro. As you can see, the Dixie is no longer confirming. You take it out to the larger time frame. Here we are back against this line. I think you could probe shorts with stops over, say, 90.40, 90.50, cracks at 200, get out of the way. Another reason that it may work today is euro is not as weak as cable. So the same type of divergence is setting up on the 30-minute in euro, right in here. And should the trade work, I'm not looking for new highs initially. You get 30, 40 pips in your favor. You lock it in, you move stops up to break even, but why can't we rally back to 124? We've broken about 250 pips since last Friday, the sneaky reversal on Friday, so it wouldn't change the downtrend that we're in, but perhaps we set up another wave to the downside, but not continuing directly from here, but up here. Give me why. You don't have to agree with me on my analysis, just so you understand what I'm talking about here. I can't chase a stellar rally up here. Everyone with me? Okay. S&Ps, I look at the S&Ps, the hourly, and I go, I want to be short, but I look at this action and, I guess I miss markets that just move sideways and then finally roll over. But this action from last Friday, 61.8 reading, just does not look, as Steve would say, for sure it's not impulsive, and almost looks like it's working off its overbought condition more in time than price. This is not much of a retracement after the gargantuan recovery that we had. So, I usually miss trades that just roll over. It's a little bit of an inside day. Maybe the turn isn't today. I still think that there's a chance before we do head down. I read Jim Walsh yesterday. He said we could pull back and this will be A, and then we could get a B down to here, and then a C, and then get the big break. I still think there's going to be a shot to get short above this moving average. I think this is where people will begin to feel squeezed here. Up here towards 2770-ish. So that's what I'm waiting for. I don't have FOMO. If I miss it, oh well. I'll look for something else, but that's my view and what I'm planning to do there. I just want to show you guys, I know subscribers know, but the improvements to the ForexAnalytix website were made to make things more convenient for you. So you used to have to, if you looked at Aussie, you'd go and you get all the Aussie research, like this is, Greg's count, he's looking for sharply lower. I know there are some pattern in plays, but you used to have to go to the section. Now, if you're, just curious about what Aussie is doing, if you notice underneath it, if there's a pattern in play, you're going to get it. So right away you're notified. So you have everything, the whole rationale for it, entry areas, target, invalidation, analysis, takeaways, everything right here. And the colors seem to be cleaner, brighter. Nice job, Steve, with the developers and Stelios on the upgrade to the website. It's very pretty. And with that, we'll bring on handsome Blake Morrill, who used to sit in a studio and have makeup put on his face before he'd broadcast for 6-7 hours a day.
Hey, Dale.
How you doing, buddy? How are you?
All right. How are you doing?
Good. Good, buddy. So where are you at with the dollar today here?
you know, the dollar is looking pretty well bid. I mean, you know, we're at some pretty important levels as far as the euro goes. The dollar yen had a really big pivot off of you know, resistance overnight when it rallied to 107, almost 107.90 or 107.90, and the euro dollar is testing the 123 level. I mean, this is all really key levels as far as the dollar goes, and you know, you know, it's all about the FOMC minutes today. That's going to be the important important. You know,
by the way, the website looks great. The improvements, enhancements, nice.
You know, there's just small tweaks, but we have really big improvements that are coming here in the coming months. So, and I'm not, you know, obviously at liberty. Whoops, let me see. Hold on, really quick. Let me change my screen here. Oops, I didn't want to pause that. Let's see. There we go.
Just in case I forget at our meeting, if we have one today, Blake, you know, as an FX Street award winner, there's some type of banner.
Yeah, it's a badge. We're putting it on our site too, actually.
Okay.
I don't know if it's been implemented yet. Steve would know. But yeah, we're putting this badge on our homepage. It'll be up here, I think.
Badge of honor. Okay.
Yeah, badge of honor. It'll be nice. Yeah, it's coming up. Actually, we were looking at the preliminary page on what it looked like over the weekend. So,
Congressional Medal of Honor, but it's a great badge.
Good morning, gentlemen.
Good morning,
Steve. Hi.
It's already on the test server. Blake, whenever we do the next push, it's going to be on the site, definitely within this working week, till Friday.
Well, there you go.
Okay.
So there it is, Dale. So it's coming up. I know Steve's been working on it with the designer. So
well, you know how much I like to brag about you guys. So it just gives me more ammo.
About you guys, it's about us.
Yeah, well, I know, but it's easier for me to say you guys.
Okay, all right.
You know what I mean? Then I'm bragging about myself, which I do too much of anyway. So.
well, yeah, we're getting that put on, so it'll be good to go. Jeez, this is loud. Hold on one second. Okay, I'm just turning down my speakers really quick. You know, so let's talk a little bit about the FX market. So here's the euro, and you can see really important
right there.
Really important support. And
so risk reward might not be bad down here, Blake. You know,
to be long.
Yeah, to give it a shot.
Sure. I mean, you know where your risk is. I mean, the risk is below, you know, I would say like 122.90. I mean, if you want, if you're sitting here pressed with something to do and you're like, I just, you know, I have to do something. Well, buy the euro dollar, you know, buy it and put a stop below 122.90. I mean, you know, I'm not taking the trade, but I'm just saying that the risk reward is here. And you know, the risk reward is to be long here, stops here, if you want to take on that risk ahead of the FOMC minutes. I mean, you know, chances are, I would think that we bounce here and we're back at 123, you know, 30. And if we're going to break down, it's going to be following the FOMC minutes. I mean, but you never know. I mean, ahead of the minutes, they could take the stops below there, and you know, they could take the stops below here, and then, you know, and then not that.
Isn't it crazy how you know, mentality shifts when we were trading at 125.5? 90% of the traders would say, "Man, I hope I get a chance to buy it around 23."
You're right.
Now here we are, and it's hard to do because will it hold or will it not? And it's just amazing how, you know, the sentiment shifts.
Yeah.
A week ago, it was like, oh, what a great buy that would be. And today it's, you know what I mean?
Yeah, exactly, and that I think that's the gist of it, Dale. Is like that's why trading always seems easy in hindsight, but when you're in the moment and you're faced with those decisions, usually we're testing, or we're at a possible pivotal level, just ahead of a key event. And this week's key event for the U.S. is going to be the FOMC minutes, which is today. So yeah, it's an interesting dynamic that we're dealt with as traders, because let's say later on this week, like let's say tomorrow we're trading up here, and you look at where we were at yesterday, or today rather, and you're like, God, I should have just bought it there at 123. That's the smart thing to do. That's what I would have done. But I didn't. Why didn't I do it? Well, there's a lot of a lot of uncertainty ahead of the FOMC minutes, and
right. Fear of loss.
Yeah,
but
yeah.
Of course. Stopping, you can't. There's no trade without potential loss. Every trade, you have a potential loss.
Right.
This is your kind of style trade. You love when markets they're going to become good or bad from a certain area.
Right.
I've been watching you.
Yeah, this is
you, man.
well, so let's talk about that. One of the trades that I took overnight was shorting the US dollar Japanese yen. Now I may have a pattern in play with the US dollar Japanese yen, but I've traded in and out of this dollar yen on the short side a lot over the last week. And as it broke through here, I was short a couple of times, and now that we've tested the underside of that trend line overnight, I shorted some, and so I'm willing to take. I'm actually, you could say I'm basically long the euro dollar right now by being short the US dollar Japanese yen. Now I know that the correlations are a little different, and the reason why the dollar yen goes down may not be the same reasons why the euro dollar goes up, but it's still a dollar play. And this FOMC meeting minutes is still coming up a little bit later today, and I wanted to be short the dollar yen when it got back to 108. That's been my plan. I've been planning this trade for the last week, and it's just like, for those of you that are like, oh, I wish I would have bought the euro dollar when I got to 123. I really wanted to buy it as it came back down to 123. That'd be a godsend. Well, here we are. If that was your plan, you got to take the trade. But do you know what where my hesitation lies on buying the euro dollar? Do you know why?
FOMC.
Well, no. Forget that for a second. Sorry, I'm yawning. Forget that for a second. What do you think? What do you think really is preventing me from buying the euro dollar technically on this chart? What's the one thing that really is? I'm going to ask you guys, the viewers too. So if you guys can look at that chart and say and tell me why I'm not.
Jacques got it.
What do you think, Dale?
Failed breakout. That's the thing you're operating under still.
Correct. So because it's a failed breakout, and those of you guys that guessed it, is exactly why I'm not buying the euro right now. Now I know I'm short the dollar yen. But the dollar yen is, you have to realize we've broken out of this major triangle. So I wanted to be short on any rally back up to this level. The euro dollar, I'm a little bit more nervous. Now, is there a safer, safer is not really a good word to use in the FX market. Is there another trade? I'm going to ask you guys, not you, Dale. Well, I can ask you too. Is there another trade I could take instead of being short dollar yen? What do you guys think? Any other trade that I can take instead of being short the dollar yen that's not dollar related? Look, I like to quiz you guys, and for those of you that are new listeners to these webinars, or you've never heard my voice before, or it's you've only heard me a few times, I love to quiz you guys because I want you guys thinking. I want you thinking. I don't want you sitting at home with your feet kicked up on the desk saying, oh, what Blake say? Did he say he was short the dollar yen? Oh, I'm going to get short some dollar yen because he's short dollar yen. No, I don't want you doing that, because at some point I'm not going to be here. You know, whether it's tomorrow, 4 months from now, 10 years from now, 30 years from now, you're not going to be listening to me at some point, okay, for whatever reason. Now, I want you to be able to do this on your own. So instead of being short the dollar yen, what else could I do? What if I wanted to eliminate the dollar out of this equation, what could I do? You know, for those of you that are thinking short euro yen, yeah, it's exactly what you can do. You could just short the euro yen, and then this way you get rid of the dollar out of the equation. Now, I choose to short the dollar yen. I chose to short the dollar yen because I wanted to get myself in a decent price ahead of the FOMC minutes. Now, and I've been planning this trade for a long time, so I took the stab there. But if you're like, well, I just don't want to deal with the dollar right now, fine. If you don't want to, you could you could short the dollar yen. I'm looking at the dollar yen, or the euro yen, excuse me. I'm looking at the euro yen, and I just don't see a good entry. I do think it trades really weak, and I think if it breaks through this support here in the 200-day moving average, this thing's just done. You can stick a fork in it. We came out of the channel, it came out of the channel. We're paused on this 161% extension of this move and 127% extension of this move. And so if we crack to new lows and break through this 200-day moving average below 131, it's over. I think the euro yens, you can just, kiss it goodbye. But that is an option for you. If you're like, well, I just don't want any dollar exposure ahead of the FOMC minutes, then the euro yen's not a bad option, because if the euro does break down, okay, and the dollar yen continues to stay below 108, then the euro yen's probably a good short. So those are just some things that I obviously think about, even though I'm not short the euro yen. It's an option for you, and I want you guys to be thinking about things versus just sitting around and waiting to hear what Blake says, or Steve says, or Stelios, or Grega, or whoever is, Nick is on here, whoever it is, just want you thinking on your own and thinking outside the box sometimes. All right, so anyway, let's continue on. So we got the euro dollar, it's sitting at 123. Is it a good long here? You can take a shot at it. If you really want to take a shot at being long the euro dollar, exactly where your risk is. It could stop out any longs ahead of the FOMC minutes. We could break through here, probe stops below these levels, and then reverse. That's entirely possible. The cable's trading heavy. I'm surprised, actually. I'm surprised that the pound is trading as heavy as it is. The reason why I say that is because the euro pound was so weak the last couple of days as we're in this range. I thought the euro pound might continue to come down, and the pound dollar might stay weak. Or be a little stronger, or outperform the euro dollar a little bit better. I thought that was going to be the case. That's obviously not the case. Aussie dollar's pretty weak, trading fairly heavy here after the 618 retracement failure. Kiwi dollar, possible double top setting up. US dollar Canadian, extremely strong. Now, let's talk about the Canadian for a second. The Canadian, by the way, if you look at the data that's coming out this week, we have retail sales tomorrow out of Canada. Today we don't have anything. We just have retail sales out of Canada tomorrow, and then also inflation data out of Canada on Friday. Look, if the dollar Canadian breaks above this 127, and then we get above the 200-day moving average, this thing could scream higher. It could squeeze the heck out of people. Remember, and I know I've said this to you guys a lot over the course of the last few weeks, especially when the dollar was getting beat up when we were down here. I said this to you guys 2-3 weeks ago. I said, if the dollar is going to show some strength, it's going to come through the Canadian first. I mean, look at the Canadian. We came out of this descending wedge, and here we are probing really key resistance. And if we scale above this 200-day moving average right there, and this thing is going to just start to ratchet higher. It's going to start to squeeze the hell out of the market. So you have to be really careful if the dollar really starts to take off and the dollar moves higher. Now, I'm hoping that doesn't happen as I'm short the dollar yen. But at the same time, can the dollar yen go down and the US dollar Canadian go higher? Yes, it can. What would happen? Dale, are you still there? I'm putting Dale to work today. If he's, I don't know if he's listening. Okay, Dale. If the dollar yen goes down and the US dollar Canadian starts really ripping higher, what would happen?
It may risk off.
Oh, it'd be risk off. Yeah, the Canadian yen would dump.
CAD
Right.
yen would get destroyed. Yeah.
Right. Well, the Canadian yen, we have a nice little double top here, and it still targets 82 yen. We're at 84.75.
You know, when the dollar was getting killed last week, we talked about how well Canada was behaving, resilient to the dollar weakness, and you know that dollar making new lows and Canada making higher lows. It's second higher low, in fact. So it's definitely been the relative strength for, if you want to be long dollar, Canada seems to be the leader.
It really has been, and you know, if you take the retail sales and the CPI this week, and if those numbers are just, you know, disappointing, you could get the dollar Canadian rallying and the US dollar Japanese yen falling, and you would have this Canadian yen really coming under pressure. This is one that I was looking for a move back up to 85.50 to get short. It's not giving me an opportunity to get short. That's the I don't have an order out. I was looking at my board seeing if I had an order out. I had an order out last week to short it. Actually, it was up here, but I would be more than happy to short the Canadian yen right at 85.50 if I could get it. And I was looking at it yesterday, matter of fact, but it just not giving us that opportunity. This thing looks weak, looks extremely weak. The dollar Canadian looks extremely strong, and that's something that, you know, you should take note especially if you're short the dollar. You know, if you're long euros, you know, or long the pound, and you look at the dollar Canadian, you should be taking note of that. It looks not bearish at the moment. You know, not saying that things can't turn, but it doesn't look like it wants to turn lower, does it? It doesn't. All right, there's a couple other, you know, I'm just going to cover a couple other of the majors really quick. You know, we got the Swissy. Swissy made a false breakdown on Friday of last week, and then we're heading back towards this 94.50, which is going to be pretty important resistance because that's previous support. Should be pretty key levels up here. The Nordic currencies, the US dollar Swedish krona is actually really more bullish than the US dollar Norwegian krona, but these also false breakdown here in the Swedish krona, false breakdown here in the US dollar Norwegian krona. US dollar Mexican peso is pretty confined at the moment. But and then here's your dollar index. You know, your dollar index is inching its way up into some resistance. We're almost at 90, which is, you know, pretty key. Just from a, you know, it's just a big level of resistance that we're pushing. You know, the dollar looks poised to move, and I think that today's FOMC minutes are going to be important. They're going to be important to the dollar as far as, you know, do we stop here and continue this downtrend, or do, you know, we reverse and give us a much more significant bounce. And if you, this is very similar to the euro dollar in the aspect of false breakdown. We hit the 618 retracement, big weekly 618 retracement, false breakdown. That double bottom right there will take us right back up towards 92, maybe even a little bit higher. So, you know, the risks are tilted, you know, right now to more dollar strength, and I'm short the dollar yen, and I'm just telling you guys that the risks are tilted more towards dollar strength at the moment, and it could happen, and it's all very, very possible at this point. So, Steve, I heard your voice earlier. How you doing?
Hey Blake, I'm good, mate. How have you been?
Good. Just trying to wake up. Still trying to wake up over here.
Yeah, that's pretty tough considering what time it is there.
Yeah, you know, I try not to complain too much because I know Dale's an hour before me, but I'm going to be ahead of me. I'm going to be catching up with Dale going on West Coast time here very shortly, which I'm not particularly happy about. Dale, is it true? As you get older, you wake up earlier?
No.
Anyhow, you guys wake up.
Fall asleep earlier, and you can sleep longer.
Dang, that stinks. That stinks.
Anyhow, you two guys sleep so early that there is no earlier.
Yeah, they're not much more earlier than we do. So
I've had to have my wife wake me up for New Year's Eve quite a few years now.
Oh my gosh,
well,
that's
honey,
hilarious.
it's New Year's, so okay. See you tomorrow.
All right. Well, hey, I'm going to pass it over to you guys as I get ready for my trading day. So good luck today, and Dale, thanks for always being here, and Steve, you too.
Okay, good.
Thank you, Blake. Have a good day, mate.
All right. Thanks, guys. Bye-bye.
Hey, Steve.
Hey, Dale.
So this dollar, stubborn, but I don't know. We're starting to get a little wick, huh, on the yen. I don't know.
Yeah,
Where's your head at? And do you kind of feel the same way as me in the S&P? Is the action, you know, everyone's getting real bearish from the 61.8, but I know it's, you know, weaker, but it's just.
Yeah, for the time being, you know, there is absolutely no confirmation that the move from the 61.8 is, let's call it a rejection, right? I mean, we've spent now 3 days, 2 of them consolidating, and yesterday we had some downside price action, but definitely, not something strong to point to, you know, a larger downfall. But as Blake said, keep in mind that tonight, tonight, if you're in Europe, in a few hours anyhow, in 5.5 hours, we have the FOMC minutes. So, you know, whatever we see there can actually stir the markets. Yeah. It can bring volatility to risk assets, and it can definitely move the dollar. And most likely, you know, the market is waiting for that. So I'm not expecting much until that time for the next 5.5 hours. But there is a very good chance that we're going to see, you know, some at least, you know, an hour of volatility following that. Depends on how close to expectations they come and how hawkish they are. Obviously, you know, there is no question about it. More hawkish has, you know, risks for the dollar's rebound to resume. Let's have a look at the DXY as we're talking about this. As we were saying yesterday, you know, there is a good sign if you want to be long the dollar. It's that we had some nice RSI divergence. It's that we retested and we actually intraday falsely broke below this confluence of multiple supports on Friday, and since then we've been pushing higher. But on the other hand, we haven't seen you know, the absolute confirmation you need that a bigger squeeze is going to come, which means that we haven't seen a higher low. We haven't seen a higher high even yet, which is the first step. And, you know, as we were saying, 91 is going to be, you know, an important stepping stone in this case, which is here. And if we break above 91, then we should see the dollar squeeze higher. Very likely it's going to go all the way to retest the 92.50 area, where we can also find this descending trend line resistance. Obviously, you know, if we get to that point and break above there, then the market's going to really start moving, because I remind you that people have been position short en masse, you know, for a long period of time already, and a lot of people are going to be wrong-footed and are going to start, you know, running for the doors. So, you know, this is, you know, a short guide of what can happen with the dollar. So we remain in a downtrend, but the risks are tilted. If we get any kind of trigger to get a dollar rally, then sentiment and positioning will do the rest. If you remember, even when we were testing the lows on Friday's webinar, specifically, I remember saying that we were testing the lows, that keep in mind that the dollar might seem to be breaking lower once again, but we need to remind you that you're either already short the dollar or already short the dollar and are in profit and you're doing well. But if you're not, shorting the dollar makes absolutely no sense. You should definitely wait for a rebound to be short quite a lot higher. And even trying to time a rebound is not a bad idea, because everything points that a rebound should not be far away. Now, has it already begun? We might even find tonight. We might even find in 5.5 hours from now. Anyhow, let's have a look at a few other pairs and see how they're positioned ahead of the FOMC minutes. You already talked about the S&P, and I'm in agreement with you. Only if we see FOMC minutes today bring up some dollar hawkiness, and on the other hand, make yields rally even further, we might see actually the S&P accelerating lower. The first area of support that we should break before even considering accelerating to the downside is 2,690, call it roughly. So if we break below there, then we can be looking 50 handles lower, in my opinion, towards 40, 44. But as long as we hold above there, we have no reason to believe that this rebound is over. So we might see, even a big rebound before we see some move lower. And I'm saying this because I remain of the opinion that no matter what happens, the risk assets indices specifically are not going to directly push higher and break to new highs. I think that the technical damage done by the downfall we had is rather significant, and it's not something we can erase within a couple of weeks. Okay, so I think that shorting another push higher for at least a few days of risk off again is a decently high probability trade, right? Now, having to do with the Euro USD, I think I don't have much to say because Blake already covered everything. I have been monitoring for a long time this ascending channel. Now, only if we break below it, we can then push towards the 121 area. And only if we push below 121, we can start considering more bearish scenarios. Until then, it's rather if you stay nimble. I'm not saying that there is no downside potential for the euro. We actually stressed that out several weeks ago, that the closer we get to the Italian elections, the downside potential and the corrective potential for the euro USD is quite alive. But it's a slow and choppy process, and one I'd rather not participate in, right? Now, having to do with other pairs, I think that there is a good chance, especially we're going to get that confirmation today. I got triggered short earlier today. I'm like 25 pips in the money in Aussie USD once again, because as I told you yesterday, the 0.79 area was an important one. We closed below it yesterday. We rebounded today, early in the day, and then we plunged lower. So I'm short once again, and if FOMC helps, I think this has the potential to at least provide one more leg lower, perhaps to retest. You can see it here. If I zoom out, perhaps to retest this broken triangle's resistance as support, right? So I still believe in the downside potential for the Aussie USD. Now, this is the only position I currently have, and I would be gladly looking for other positions as well in several pairs. Blake already mentioned. Let's have a look at the Kiwi, by the way, since they're correlated. Kiwi needs to break below this zone to actually open up, the downside potential. I think that if we break below this, let's call it 73.30 support, then we will have a gap, a gap, no, not the right word, but we have an air pocket, let's say, of 100 pips. So I think that these 100 pips can come quite easily, as long as we get a daily close below there. USD CAD, Blake already showed that. I just want to reiterate that what we said, 126.60, quite important. We're testing this zone once again. If we break above it, then we go for 128. Above 128, we have 129. Above that, we have 130. It's literally every 100 pips, we have some kind of a resistance zone. But I think that a break above 126.60, which looks extremely likely, can provide more potential. We were monitoring this as a descending wedge. The descending wedge broke. The corrective move lower we had the past few days really looks like a bull flag to me. So, why not? I mean, the vast majority of the dollar pairs here, even if it's for a corrective move, show the potential or the intent for the dollar to strengthen further from here. Same with the cable. Cable looks very likely that it will at the very least come down to retest the 138 area if the bottom, the flat bottom triangle case is the proper interpretation, because don't forget that we also have a possible interpretation of a bull flag, in which case we can move quite lower, right? Going all the way down to retest the 136 to 25 broken area. So in one case, we have 100 more pips to the downside. In the other case, we might have like 300 pips more to the downside from here, and still not constitute anything like a bearish development or whatever. Just a healthy A, B, C, or whatever you want to call it, corrective move to retest the breakout area. So even to provide some deeper corrections against several pairs, the dollar has really the potential, as long as the FOMC minutes permit today, to rally decently significantly from here, right? Blake already mentioned the USD yen. The USD yen, we said yesterday, 108 was the first area of resistance. We seem to be getting rejected from there. According to the way I have the trend line, we haven't tested the broken trend line, but you know how it is. Depends on how you decide to draw it. If you take into account wicks or whatever, it can come higher, it can come lower. Doesn't really matter. Bottom line remains that we rebounded from the area we were looking, as the next area of support. But as long as we remain below, let's say 108.50, I think there is absolutely nothing bullish with the USD yen. So USD yen also has the potential of moving lower from here. And as Blake said, USD yen has significantly diverged with its usual correlations, during the past several weeks, which means that you should not exclude the possibility of seeing the dollar rally against several pairs, but not really rally against the USD yen. Because, for example, if USD strength comes along with treasury yields strengthening, and that brings some risk off, then there is a good potential that the USD is going to be strengthening against almost everything besides the USD yen. Right? Here is the chart of the yields as well, by the way. There's nothing bearish to it for the time being. So another thrust higher from here seems extremely likely from a technical perspective as well. Right? And here are the treasuries. So we need to see what's going to happen from here. Are we actually going to break lower, or are we going to get some kind of a scenario that this plays out as a descending wedge? I think we're going to find out all that in 5.5 hours. So, quite a significant day. We said in advance that the CPI was very significant. The CPI actually more or less gave us a tradable low for the DXY, irrespective of the fact that we intraday broke below it on Friday, but on a daily closing basis, it gave us a tradable low for the time being. And, the FOMC minutes might might actually provide another push today. So tomorrow, I think we will have a lot more things to discuss. And I think that the market is going to be more free to extend some of the moves and show us its real intentions and the real potential. By the way, I'm just having a look at my screen of big movers, and I just want to point out the last thing I mentioned yesterday, because a friend of ours asked here, was the USD ZAR. Keep in mind the USD ZAR seems to be accelerating lower once again. We already have an outside black candle today, so what I said yesterday still applies. I know it's not a very popular pair, just mentioning that. So let me go ahead and have a look at a few questions, because I think we have several coming in. Hi Blake, would you in the case usually consider shorting pound USD if you found euro pound stronger? As using correlation, one would expect more move from the weaker pound. Thank you. Okay. First of all, as I said yesterday, first of all, the euro pound remains in a very, very choppy range, right? But ahead of the Italian elections, there is a decent chance that we might see actually some euro pound weakness. I fail to see many possible scenarios that would cause the euro pound to break higher before we get a resolution having to do with the Italian elections. So having to do with that, I think that probably not happening anytime very soon. Okay, I think that until the Italian elections have been resolved, we will either see euro pound remaining trapped in this range, or potentially even pushing lower from here. So seeing euro pound break to the upside before we get the Italian elections, so that can spill over to some further pound weakness, I think it doesn't have high probabilities. I've been studying correlation when it occurs very much recently, using what you shared with us. Thank you for all. Okay, I'm going to transfer you. Thank you, Leon. Watching from mobile from bed while on my price study never stops. Indeed. Pound Aussie and pound Kiwi. Okay, sure. Let's have a look at them. Here is pound Aussie. Nothing has changed since yesterday. Actually, if you see, we've spent like, what is it? From 1st of February, actually, we've been in a very choppy environment, right? I mean, we're moving lower, higher, lower, and now we're in the middle of, let's say, this range we've created. But on the other hand, this ascending channel is holding, and we're also holding above the 176.50 area. So I'd rather not participate in this, but I can't really be bearish. I mean, if I had to do something with it, which I don't have to do something with it, so I'm not doing anything with it, I would have to remain bullish if we're talking about the medium term. Now, the pound Kiwi is depreciating slowly, but it also remains within. If you zoom out, you can see that you can call this a triangle above the broken triangle, right? So in the medium term, despite being weaker than the pound Aussie, and that's that's a product of Kiwi being stronger than the Aussie. We're going to have another look at the Aussie Kiwi after this. I think that as long as we remain above this blue trend line, I'd really not be bearish the pound Kiwi as well. Obviously, if you want to be bearish one of the two, you will choose to be pound Kiwi instead of pound Aussie. But nothing much to see here yet. I'd rather see a breakout from here to buy, right? Now you can see why by zooming out. Okay, let's have a look at the Aussie Kiwi that I said. Aussie Kiwi, as we had predicted when we broke below 1085, it's been behaving extremely technically well, because as you see, it finally broke below a very, very well indicated area of support. It came back, it retested it, it moved lower. It broke below the next area of support, it retested it, it's moving lower once again. I really see no real support until 1055. So I think that there is another 130 pips to the downside at least, that the pair can keep on moving downwards more or less unopposed from a technical perspective a bit, right? So I think that Aussie Kiwi remains well positioned to suffer further losses, and that means that Aussie should stay as the preferred short against the Kiwi, right? Yeah, Zach, I'm gonna keep my Aussie USD short, yeah, for the FOMC minutes, yes. Pound yen, let's have a look at it. There we go. Okay, as we said, the pound yen had a significant bearish development, which is what? Breaking below this ascending wedge. But on the other hand, to get full confirmation that this thing has completely changed its behavior and should be viewed as bearish, we really need the 148 level, 147.50, 148, this zone to break to the downside. Because if that happens, then we get more of a confirmation that it's actually breaking lower, because then it will be breaking lower from this ascending trend line as well, this blue one, and at the same time from a horizontal area of support that has been very significant because it has acted as support and resistance too many times in the past. You can look at it here, right? Support, resistance, 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 support, support. Once again, a support a few days ago. So 148, a key level. As I said, it's not a single level, it's a zone. Let's call it 147, 51, 48. Now, if we break below there, I think that the pound yen can move a lot lower from there. Right, as long as we remain above there, you can be selling rallies, but you should be very careful when we get close to that zone, because that zone has the potential of creating more rebounds, right? As we've seen it act several times as a resistance before it finally broke to the upside, it has the potential of acting several times as support before actually breaking the downside. So you can be selling rallies, but whenever we get close to 148, you should be at least trimming your risk. That's what I think. USD ZAR is on a VAT increase announced. Okay, Zach, thank you for the information, from 14% to 15%. Okay, not that significant to be honest, but yeah, it is something that can move the market. Your thoughts on the pound yen, please? Oh, we just covered it. 0.90, 0.90, 50 possible EG. You're talking about the euro pound. Let's have a look at it again. Possible, anything is possible in the market, but really, in my opinion, before we start even considering that, we have an area of resistance here that has rejected price action several times. It's the 0.8930. So we first need to clear that, which has proved very tough to crack for several weeks now. Then we need to crack above the descending channel before we consider that. In my opinion, if we do get to 90.50 that you mentioned, there is a very good likelihood that the pair is not going to stop there, that it's going to go quite higher from there. So for me, the important is not getting to 90.50, is going above, let's say, 89.30, right? Euro Aussie, actually it's a question. Euro Aussie up from here. Let's have a look at it. And since we are at it, we can have a look at the euro pound as well. Now, the question is, euro Aussie up from here? The answer is, it is very, very likely. Why is it very, very likely? For the simple reason that this looks pretty much as a bull flag to me. And the pair has kept behaving very nicely from the bullish perspective. I mean, we had a corrective move lower. We respected the uptrend because we formed another higher low. we formed an inverse head and shoulders formation. We broke above the neckline. We actually completed the pattern by getting to the target. Actually, we went above the target. And since then, we have been consolidating near the highs. We actually pushed to new highs, and now we've been consolidating near the highs in a price action that in no way is impulsive. So choppy, slow price action that oscillates near the highs after another move to the upside in a well-defined uptrend. Yeah, absolutely. I mean, a break to the upside has a lot more potential than a breakdown. And if you want me to be more specific, as long as we trade above 155.80, there's really no other interpretation than a bullish one. Now, for the reasons we mentioned before, having to do with how the Aussie is behaving against the Kiwi, obviously you should choose to be long the Euro Aussie and definitely not the Euro Kiwi if you want to be long the Euro against one of these commodity currencies, right? You can see here that, first of all, the Euro Aussie has pushed to new highs, the Euro Kiwi has not. The Euro Kiwi also formed an inverse head and shoulder formation, an inverted one, but it never managed to reach the target. And as you see, it's more or less consolidating quite below the highs. So shows a lot less potential than the Euro Aussie. So it's a clear choice of which of the two you can be long. What are the catalysts to move the pound yen lower? Ed, you know, it's quite simple, right? Since every currency pair is a currency pair, anything that can move the pound or the yen, you know, can cause it to break down. Obviously, if we get a combination of the two that, you know, would point to the same direction. So, for example, if we get some bad news about the potential developments having to do with Brexit, and at the same time we have a risk-off market and the yen is strengthening, obviously that has, you know, that can cause the pound yen to really accelerate lower. So any day we know that can bring headlines having to do with the British economy and the British diplomatic developments having to do with Brexit, and that can be a catalyst for a move to either direction. And on the other hand, you know, we've seen a yen that against expectations has been stubbornly strengthening, and we still don't see any reversal for that. So the yen is already, you know, on a good path to, you know, provide some pound yen weakness. Now, on the other hand, if we get some bad news that affect the pound to the downside, obviously you understand that in essence the stars are aligning for some acceleration to the downside for the pound yen. Palladium turning lower at the 50% retrace. Yeah, thank you for reminding me, because I actually wanted to have a look at palladium because it is one of the strong movers. It has been one of the strong movers today. You know, after we broke above there and they got stopped at break even, I made some nice money being short from there. But on my second attempt, I stopped out on stopped out on break even, and I am looking actively to perhaps be short once again. But I'm not, and I'm not looking to do that yet, because ideally I would want to see this ascending channel being retested as resistance. So if we break down from here, unfortunately, I'm not going to be in it. Now, if we actually push higher to the channel and I see some kind of a rejection there, then I'm going to participate once again to the downside, because I do believe that this move lower you know, has the potential of being interpreted as an impulsive one, and at the very least we should see one more push to the downside. So yeah, I'm looking to be short palladium once again, but I'm not yet, and I'm not really convinced that, given the 6 consecutive updates that we had, that these 3 days of price action are enough to point to a continuation to the downside. I think there might be another push to the upside before doing so. Now, we're going to find out if that's the case. In one case, it's good. I'm going to be in it. In the other case, it has to do what it has to do without me. Speaking about palladium, let's have a look at oil. Oil is about to show us if it has found a tradable low or not, meaning I'm waiting to see this retracement after this bullish move and how strong or weak it's going to be to actually get some clarity on what kind of low, if it's a tradable low, we had at 58, right? So this is a market I'm actively monitoring. And going now to the other metals, silver and gold, we have to say that gold suffered, a lot yesterday. There's no question about it, but remains more or less in a choppy range. I think that this can end up being a larger triangle, but nobody can be really sure because, gold has been quite deceiving lately in its intentions, and even correlations have been weird. So I'm viewing this for now as a bigger range and waiting to see what's going to do from here, right? We didn't get a new high, so I can call it like a false break to the upside and really turn bearish once again. So, we're in the middle of this range. I think that despite the strong move lower, you shouldn't be fooled by that, because just have a look at how many strong moves gold had only to reverse and then provide us with strong moves to the opposite direction. I think this is a little bit of a messed up market at the moment, and I'd rather get more clarity before I do something with it. I tried to trade it several times, got stopped at break even several times, made money once, lost money twice. So the larger picture I had in mind was obviously not the correct one. And usually when you get ranges and choppy price action, it's not easy to get a resolution. So I'm going to be more patient with it. Now, having to do with silver, it's much better behaved. I think that silver looks more bearish than gold does. You can see that, we broke below this formation. We came up, we retested this resistance, we're moving lower, but still, there's no momentum here as well. So if you zoom out, you can see this is a large, choppy range of price action. I think that, in looking at the big picture, nothing much to do here as well at the moment. Dale, are you here, mate?
Yes, I was just muted, buddy.
Yeah, no problem. Do we have an interview today?
Yes, Konstantin Gurdjieff. I'm just waiting for him to check in.
Okay. What is Konstantin going to speak to us about?
He's an economist from Dublin. He's going to be talking about volatility, money velocity, things up Stelios' alley.
Very, very nice. Very nice.
Maybe I'll ask him about the Italian elections too.
Why not? It's not a bad idea.
It's my show. All right, buddy, but he's not in the room yet. I'm communicating with him on Twitter. I think he's about to check in. Are you about finished? Is that why?
Yeah, let's have a look at copper as well. Okay.
I'll let you know. I'll let you know when he's in. Okay.
Okay. Please do not anything else, because I have an important meeting. The moment I'm done with the webinar, I have to go meet our head of development. He's in Athens for a day. So I'm going to have to go meet him. Okay. So copper remains in. We pushed lower from there, but in all honesty, I remain of the opinion that copper looks bullish for the time being. You can see that very clearly here. This is likely a megaphone formation. I think we might find support at the 315 area. So we're rather close to that point. So I think that copper remains constructive any way you look at it, right? Let me see if I've missed any question here. Okay, I don't think I have. Okay, I think we covered everything. So
I think I gave him the wrong link, Steve. But I would like to say to anyone who bought the euro when I was talking about it on the early opening, you have 15, 16 pips. You could always take half off and tighten up your stop in front of the Fed minutes today. So you put
yeah, I think as usually we might see from this point on until we get the FOMC minutes, the vast majority of the tickers just trading in a low liquidity environment in mid range. So
well,
I
I'm
would
just
really
saying in case someone wanted lunch money to go to McDonald's, that you have 15, 16 pips.
15, 16 pips can be a lot of money, depends on what size you trade, right, Dale?
Well, one lot, you could take your girlfriend to McDonald's nowadays. $15. So.
Indeed. Stelio, do we have anything from your side, mate?
Not really. I mean, you covered a lot of stuff, and the main thing for me is next, not this Sunday, the Sunday after with the Italian elections.
Italian elections, yeah.
Not a lot expected really, but that's kind of something that scares me a little bit. When the market is pricing very little into an event that could be, it's a binary event. It scares me a little bit. So.
Yeah, actually, the scary part about the market not pricing in much is the fact that no matter what happens, you should get things moving either one direction or the other. Oppositely from, let's say, getting an event like, for example, the US elections, that the market was pricing in, let's say, 96, 98% like a Clinton win. So if Clinton actually won, we wouldn't have much happening afterwards. But Trump winning, we got some huge moves happening immediately after. In this case, that means the market is somewhere in between, which means that if we get something good, for example, a coalition of right parties, we probably should see euro strengthening and risk assets in Europe get bid, while if the opposite happens, if we see the five-star movement and how's the other party called, Stelio?
Actually, I can't remember. But what I want to say is, I think one of the amazing reasons why the market's so complacent is that the five-star movement in the beginning, a year ago, they was claiming very gung ho and all.
Yeah, we're going to take Italy out of the euro
and European. Yeah. Now they've mellowed out. They've actually changed. Hey.
Sorry.
Hey, Dale.
Oh, just want to let you know.
Is your guest here?
Yeah, he is.
Okay, perfect. Go ahead. Perfect.
So what were you saying, Stella, about the Italian elections?
I was just saying that the five-star movement, that party, have changed a lot their narrative over the last few months, and they've become a little bit more neutral rather than this, gung-ho outside of the EU. And
still, the market is not going to be very enthusiastic about them.
Yeah, I agree. But to a lesser extent than it was,
Absolutely.
Ago, I think. Yeah.
Absolutely.
Who's their candidate? Benito Mussolini?
No, Adolf Hitler.
I can't remember.
Oh yeah, he's not around anymore. All right, guys. Nice job, Steve, Stel. Thank you. Constantine, I see you. I'm going to make you a panelist because I don't know if you brought anything to show us, and I'll show your website. So all we need is audio. Thank you very much for returning when we had some audio issues last time. And I'll show your website while we're speaking.
Hi, Dale. Do you have me there?
Got you, buddy. You sound so much better than last time, Constantine.
Excellent. Yeah, I sorted out the headphones this time around, which is easier.
Well, you know what? It's great to have you back because a lot has happened since our last conversation.
And a lot has happened.
Yeah. So, I know we have a couple of topics we want to talk about, but perhaps we could start with what everyone's talking about. Do you see any impact from the upcoming elections in Italy?
Well, I just caught the tail end of your discussion there about the Italian elections and the whole notion of the European markets being complacent about the geopolitical risks and general risks coming out of a major country like Italy. And this is absolutely perfect to the general broader theme that I think is really important overall. And that's the theme of the degree of complacency in the markets and the disconnection between the dynamics in volatility in the markets and also the dynamics of the deeper uncertainty in the market as well. I mean, if you take Italy, for example, what you discussed there from the political point of view, the whole breakdown of different parties, the disconnection that we have seen over the recent probably decade plus between the traditional body of politics in Italy, which was dominated by traditional center-left, center-right parties with no ideologies. Now we have the populism, which is still elevated in Italian politics. And yet, at the same time, while we talk about political environment, we're kind of setting aside in the markets the issues which really matter, things like Italian economy, which hasn't really grown in the last good part of more than 2 decades now. Banks, which are still in an extremely sick condition, not just Italian, but Eurozone banks in general, over 1 trillion bad loans, non-performing loans in Eurozone banks sitting still. And this is 10 years after the crisis.
The Italian banks, Constantine, they trade in like, you know, low dollar figures and even decimals.
Sure,
they're the sickest of the sick, aren't they?
They are the sickest of the sick, but the point is that it's not so much the banking system which itself important. The issues for the broader markets, European markets in particular, broader markets and global markets, is the interconnection between the sickness of the banking system, like the Italian banking system, and the underlying weaknesses in the potential growth in the economy. If you translate what's happening in the Italian banks into what's happening in the Italian economy, we're celebrating growth rates sub 1% in Italy as some sort of the miracle happening. We're celebrating growth sub 2% in Eurozone as another miracle happening. We're celebrating growth in the United States, which is sub 3% and being revised down as we speak all of the time as some sort of a miracle as well. All of that is
very low bar we've set.
Extremely low bar. But that low bar is set against the backdrop of unprecedented monetary expansion, both in the Eurozone and in the United States, unprecedented fiscal expansion in the United States, which is not only ongoing, but is now accelerating into the growth cycle. So we have a procyclical fiscal policy, procyclical monetary policy, and the cycle is extremely weak, which tells you that there is, you know, markets currently are exhausted searching for a catalyst for any sort of the serious upside or even the downside. The good news is we had a correction. That was brilliant. That was the first time majority of traders at the trading desks started waking up to the possibility that the markets can go down, as in systemically down, in a strong downward direction as well. That was the first time the millennial traders kind of got their, you know, hands a little bit shaken. We survived through that, which is good news, means that we gained some experience. But now we're in this period where both the volatility as measured by the actual intraday and interday trading results, and also at the same time revealed by the likes of the VIX family of indices, is in a completely psychotic territory. So if you go back and you look at where we started this month, we had a notable spike in revealed volatility in early part of this month. This is now fading out. So if you look at VIX, ranging 10 to 11 points through January 26, rising to 14-15 range through February 2nd, then shooting straight up to 25-27 range between February 3rd, February 13th. Since then, we are back into 19 to 20 range for VIX. At the same time, what does that tell us? 3 things. First, volatility is back, but it is moderating. So again, that is not exactly convincing. It still is elevated, but it is moderating. Second thing it tells us is that the markets are searching for a catalyst, and more crucially, the volatility of volatility is up, which is to say that uncertainty is brewing up and starting to press up back again. So this flies in the face of the fundamentals. If you look at our earnings reporting season, this is almost over. Numbers are not too shoddy. We have another record year if you measure December 31st through February 15th in terms of the reported earnings per share for the S&P 500. This is kind of a brilliant type of news. If you look at the forward guidance in terms of the earnings coming during this season so far, and again, looking at the data through February 15th, we have very significant uplifts across pretty much all of the traditional sectors. Healthcare leading, technology is pretty strong, financials, even cyclical consumer goods are starting to show life as well in this reporting. And despite all of this, if you look at the underlying positions of the major hedge funds, they're scaling back from the traditional exposures linked to the S&P 500. FANGs, Facebook, Amazon, Apple, Netflix, and Google, all of those exposures are now down for the hedge funds as they report, and their bets across the market are now being spread much broader across different exposures, smaller companies, smaller caps, and the sectors as well. Why?
Yeah, interesting.
Again,
the Russell bounced back the most, which
exactly.
Okay, so people are starting to look for value and beginning to shun the FANG stocks. Is that your view on it?
I think what we're seeing is that less so of an issue of the people trying to find the value, and more so of an issue of people trying to find a next theme. And when there is no big dominant trend driving theme in the markets, when the markets are in a kind of state of the reprice and all of the upside being completed, and that has been done from the early February correction onwards, they are now trading sideways. When you're trading sideways in an environment which is volatile, you might as well make a bet on more distributed portfolio. There is less concentration. FANGs themselves, again, Facebook, Amazon is doing pretty well actually in the last few days. Apple, Netflix, Google, all of those major corporates in S&P 500, which drove, by the way, S&P 500 over the recent years, and now starting to be seen as the indicators of the broader economy. And as the broader economy overall, global and the US, is shifting the gears towards the flatter rates of growth, towards more uncertainty about that growth, the markets are starting to reprice that as well. And if you look now at the underlying uncertainty indices, they're telling us exactly the same thing. Whether you take, for example, US economic policy uncertainty indices, US equity markets uncertainty indices, geopolitical uncertainty indices, monetary policy uncertainty indices, all of those indices have moderated from what we saw at the beginning of the month, but at the same time, they are all staying way above their historical averages.
Yes. So even though it was a scary correction, do you think that there's the potential for those lows to be taken out before an uptrend? Maybe the next catalyst is not something that sends the market to new highs, but to possibly take out S&P 2550 and go to 2400. It looked a little too pat that we held the 200-day moving average. You know what I mean?
Look, I mean, it's very interesting what you're saying. I'm a contrarian in many ways. You know, as a contrarian, I'm accustomed to the cycles of the news, which actually are countercyclical to the markets themselves. So when things are really happening to the downside in the markets, us contrarians get the calls. We get to write articles, we get to explain what the hell is going on and all. When things return back to the trend, we are kind of being, you know, pushed aside, and it's just the cheerleaders in the market which come out. So in the last few weeks, I've had an absolutely, you know, active life in terms of writing about what's going on in the markets. And back at the beginning of the correction, I actually put a number on the US markets in general, equity markets in particular, saying that the actually systemic correction would require a protracted downward shift in terms of the prices to the tune of about 17 to 20%. Now, given that we haven't reached that bottom, to me the correction was incomplete to begin with. Given that we have bounced back from the bottom so fast, it tells me that that was just a pure technical correction rather than fundamental repricing back to the actual underlying capacity of the US economy and global economy to sustain valuations. So I am still betting that the market is overvalued.
Since the bounce back, Konstantin, have your phones and emails gotten quiet again? And once again, you feel like a prophet from the Old Testament?
No, look, I mean, I think that people are still rattled. And I think because of the people starting to realize finally as thanks to this correction, that two things have happened. First thing is that the volatility have shown us once again that spikes in volatility can come instantaneously, and when they do come, there's very little warning in terms of the upward dynamics. Remember, VIX, slight uplift on a Friday, in going into the correction, sorry, in Thursday, going into correction, and Friday, big spike, followed by another big spike and all. So there's very little warning signal in volatility, and people are nervous about that. But I also think that a lot of traders are starting to pay attention.
I have to push back on that, because actually there was. Because when the S&P was blowing off to the upside, making new highs day after day after day, the VIX was not making new lows. It was actually rallying with the market. So there was a little bit of a market tell, wasn't there?
Well, the margin was very small. As I said, as I give you the numbers, if you look at the average ranges for VIX through January 26, 10 to 11 points, and that rose to about 14, 15 point range through February 2nd. So in percentage terms, yes, but it was coming up from very low levels. So, you know, it wasn't convincing. What was convincing, what happened February 3rd onwards.
Yes.
And that conviction actually now is starting to feed to a large number of traders and investors, in a sense of saying that, look, just being complacent about the actual revealed volatility and being complacent about the priced in or, you know, VIX signaled volatility is not enough. You have to start paying attention to more fundamental, deeper drivers, such as uncertainty and ambiguity in the markets. And we have a hell of a lot of uncertainty and ambiguity, especially ambiguity. If you look at, for example, the forward policy drivers for the US economy and for the US markets, it's very hard to say what's the next catalyst can be. We had very big announcement, for example, in terms of infrastructure investment plans, 1.5 trillion, multi-annual program, and everything else looks brilliant as the announcement goes. But it gives you two kind of, if you want, back thoughts. The first one is, how the hell are they going to pay for it? And the latest budget deal clearly shows that there is no money to pay for it. So the second thing that is happening also is that you are thinking, okay, even if it does happen, that is a pro-cyclical fiscal policy. Last time we had strong pro-cyclical fiscal policies in advanced economies was during the boom of 2004 through, it really started around 2002. So, okay, 2002 through 2006. That ended up in a massive blowout. Remember, 2002 was after the short-lived recession and dot-com bust. So we're starting from the lows and we're feeding the cycle upwards from the lows. Right now we're starting from the highs and we're still feeding the cycle up. So it's not comparable to 2002, as some people think. It's more comparable to about expansion during the 2005, 2006. Does this current cycle have 2 years to run? Maybe. But on the other hand, if I look at the underlying growth coming out of all of this effort, of all the fiscal spending, of all the deficit financing, of all the monetary
every
excesses.
Every economic weapon, haven't we now? Since
Exactly.
the handoff from monetary to fiscal.
Absolutely. And what's interesting about this is that the Fed is quite aware of the fact that the bullets are gone and the bear might be waking up once again. And if the bear wakes up once again, where do we go from there? What monetary policy tools do we have left? What fiscal tools do we have left? I mean, what's the debt is going to be like? What's the, you know, I mean, forget the debt ceiling notion. That's just a rubber band, you know, trying to hold a shark, you know. But even the idea, the notion of the debt reaching Japanese levels, that's where you have to go if we're facing right now a cyclical risk, which we are. And the Fed is worried about it. So they're going to jack up the rates or try to jack up the rates as soon as possible.
Yeah, so Paul, you know, they've tested every new Fed chairman, Greenspan with a crash, Bernanke with a financial crisis, of course, Janet Yellen got a pass. But I'd like to switch from the V of volatility to the V of money velocity, which even if this cycle lasts, could be a longer term problem that, you know, banks aren't lending to each other. Can you address money velocity? And you say the Fed has a problem. So if you see it, they see it. And how are they going to deal with it?
Well, that's true. The Fed does have a problem, and it's not a new problem. It's been continuing for some time now. money velocity, whether you measure it by M1, M2, or broader velocities, has been declining, roughly speaking, from around beginning of the global financial crisis onwards. In part, that is of course driven by the fact that we're printing a hell of a lot of money in the United States, or printed a hell of a lot of money. But the trend continues downward, despite the fact that the quantitative easing program stopped and flattened out. So there is very little uptick in the money velocity at the M2 level, and basically imperceptible uptick in money velocity at the broader money level, no uptick in M1. All of that is technically a function of multiple things that move around, but for me, what's very interesting part, which speaks to the fundamentals of the economy, is the gap between M2 and M1 velocity. That gap, in effect, is a proxy for savings in the US economy. And that gap has been negative since 1959, let's put it this way.
Okay.
So in other words, we are a
I remember I was 6 years old and bought a savings bond.
Well,
Okay.
back in those days, it was moderately, negative at about 2 points,
Right.
the gap itself. It currently stands at about -4 points, which is not too shoddy. Again, it's better than it was when it was at about -9 points back in 2007, and it's been rising since then, indicating that there is some deleveraging in the economy which was happening. Sorry, not deleveraging, rather than re-leveraging in the economy has been happening slower. That said, okay, if you look at the last few months, okay, and the gap is still negative, we have a very major problem on our hands. We've printed a hell of a lot of cash. A lot of that cash was supposed to help the households and real companies to deleverage. Of course, we've seen exactly the opposite. They re-leveraged. And as a result of that, the debt levels carried by households through the short-term credit and long-term credit are currently above the pre-crisis levels. The same applies for the corporations as well. So United States real side of the economy, the demand and supply sides of the economy, are actually carrying more leverage risk today than they carried during the right before the peak of the global financial crisis. On top of that, of course, all of that coincides with a huge amount of money printed out. So where's the money? That's your proverbial question, yes?
Right.
Have we wasted the money by pumping it into the financial system, which is effectively not transmitting anything to the real economy side? There is no investment cycle. There is growth cycle, as we spoke at the beginning, is anemic. And all of that is underpinned by tremendous levels of debt. So if I look forward, and I look at the forecasts from the IMF and the World Bank and the other agencies in terms of the potential GDP growth in the United States, not surprisingly, the GDP gap is now positive. So we are running overheated economy at 2% growth rates.
Wow.
When you strip out of those growth rates, out of GDP growth rates, the financial sector, we're in 2%, if not even lower, as a result of that. And exactly what comes up then is, wow, where is the current valuation of the market going? Do we need to have a jump to 5% growth in real terms in GDP in order to justify current levels of market? It seems to me that the markets have priced in the potential for growth for in and around 3.5–4%. Basically, almost in line. Exactly, it's not even Goldilocks. It's not even Goldilocks. It's the dream state that the current presidential administration is hyping up as their target. In the meantime, nobody serious is forecasting growth over 3% right now this year, which is kind of major disconnect. And that brings us back to the whole issue. What's to expect forward? I think we're going to expect forward. We should expect forward sideways trading markets with a lot of volatility, a lot of spikes in volatility. So higher levels of volatility off volatility, and all of that implies that there is ambiguity, there is uncertainty, there is unease amongst the investors.
Love it. People need you when it's not a one-way street, buddy. I can't let you go. I can't let you go, Konstantin, without asking you about Bitcoin. Last time we were on, it was peaking up around 19,000, went to about 6,300. We've recovered here. What's your take on recent developments of regulation, etc., and the cryptocurrency world, which doesn't seem to be going away that I just do not understand?
You are not the only person who doesn't understand it. I think maybe we are just too old for this stuff, and that's what some Bitcoiners tell us. My gut feeling is that when I read research published by the academics who are 30-year-old professors, they are young enough to understand it, and they don't understand it. So as a result of that, the good news for Bitcoin is that it is still around. The good news for Bitcoin is that, as you said, there is a kind of yin and yang. There's roughly balancing out act right now going on in terms of regulation. Some regulatory bodies are very aggressively curtailing Bitcoin activities or cryptocurrencies activities in some countries. Other countries are actually kind of going more laissez-faire. It's not that they're regulating it directly, but they're going laissez-faire. An interesting dynamic that is developing right now is that we're getting into the tax season in the United States. And this is the first year that the revenue is literally, the IRS literally targeting cryptocurrencies. So we'll see what the fallout from that is. In the meantime, again, you know, Bitcoin actually, strangely enough, in the last couple of weeks, I've been watching on a daily basis the charts, and it's showing normal dynamics. I mean, there is healthy, reasonable volumes. The volumes actually coincide with trading direction, and the magnitude of volumes coincides in terms of sell orders coincides with falls.
Yeah, it's a very viable, high beta instrument.
It's starting to look like an instrument which has a small niche. I mean, I think it is still severely overhyped and probably overpriced, but hell, in that sense, it is exactly like the S&P 500, yes? And like Dow Jones Industrial, you know, you can't really say that this is a fault of Bitcoin. I mean, it is, and in many ways, what's also interesting about that is that Bitcoin has shown through this crisis a very strong correlation with other asset classes. So the idea that, you know, some Bitcoiners forwarded that Bitcoin is a natural hedge and safe haven against the macroeconomic shocks transmitted through the traditional asset classes really is not holding the water at all.
No, it actually peaked before the market. It was almost a precursor for the correction in equities.
Yeah, and correlation
bottomed around the same time.
And correlation is, again, on the short-term dynamics, is pretty much in line with being positive, strongly positive, which is the exact opposite of the safe haven instrument. Safe haven instrument is defined as something that shows the negative correlation at the time of the pressure. So anyway, so that's a very interesting thing. I think the other interesting thing is that Bitcoin is probably benefiting very strongly now from the reallocation of the illicit fund flows to other coins and from the kind of increasing degree of legitimization, which is good news, I think, for everyone in the markets. The stronger the degree of legitimization of an asset, the more sustained the demand there is, the more diversified the investment community is, and the deeper the markets for that instrument. So in a way, there's some positive developments for the Bitcoin. Is it going away? I don't think so. Are the current valuations based on any sort of deep fundamentals? Not at all. Are they still driven by hype? Yes, but they're increasingly driven less by the illicit flows, which is good news.
What a great interview, Konstantin. I want to thank you so much for coming back, and don't lose that headset. And and really, some of the things we talked about and how you crystallize things for people, I really encourage anyone who is watching us live or sees the video later to bookmark your website at macroview.eu.com, and you can follow Konstantin on Twitter at GTCost. And if you want to have your finger on the pulse of what's happening economically in every area, because Konstantin, you cover everything. And
thanks, Dale.
I really enjoyed talking to you, and I promise we'll do it again.
Mutually, absolutely. Let's do it again anytime. Delighted to be with you.
Thank you so much, everyone. That's our wrap for us. That's Konstantin Gurdjieff. If you took my idea earlier in the euro down here at the bottom, now you have 32 pips. So if you didn't bank 18, you bank 30, and now you trail your stop to under the low. Good luck on the Fed minutes, And most of all, don't just count your pips, count your blessings. We'll see everyone tomorrow, and we're live streamed on investing.com. Adios. Thanks again, Constantine.
Thanks, Dale.
Bye-bye.